Hello. This is the Keiser Report. I'm Max Keiser. Stacy Herbert, how's it going, babe?
Max, it's going very well.
All right, that's cool. Listen, I saw something in the Financial Times that I want to share with everybody out there, okay? It says, fresh moves to unlock loan pool. You see, the world is faced with a global calamity of deflation. And the banker's answer is, let's not deal with the fact that the economic model running the world is basically bankrupt and broken. Let's try to figure out how to refloat these bad loans, as they call them, unlock the loan pool. It says the biggest European banks are seeking to revive the struggling wholesale finance market with a new kind of enhanced security product designed to attract lenders such as pension funds and hedge funds, according to a senior banker. International money markets have periodically seized up since the credit crunch of 2007, and many European banks and savings banks, especially those from Spain, are currently unable to access credit and funds. There's a good reason for it. These banks have parlayed hundreds of billions of dollars worth of bad debt into hundreds of trillions of bad debt, into an inverted debt pyramid. And the only way that anybody is ever going to see economic growth again is to let debts that can't be paid go down to zero, and we start all over again. But it's going to take, Paul Krugman over the New York Times, he's still wishing for the Keynesian stimulus nirvana approach. It's just not going to work. But we'll just keep track of this, the insanity of resecuritization and the FT tracking these guys as if they have a brain in their head, which they don't. Let's move on. Stacy, tell us more.
Max, well, you make it sound so easy. This first headline would say, you're wrong. Economics is hard. Don't let bloggers tell you otherwise. This is Kartik Athreya from the Federal Reserve Bank of Richmond. I argue that neither non-economist bloggers nor economists who portray economics, especially macroeconomic policy, as a simple enterprise with clear conclusions are likely to contribute any insight to discussion of economics, and as a result should be ignored by an open-minded lay public. So they even use this word lay public. It just brings us back to medieval times, as you often talk about.
Exactly. It's back to pre-Enlightenment, back to the feudal system. And just like the church at that time didn't want the common people to get access to the Bible that was printed up and accessible and translated into the people's language, the Politburo of this global Federal Reserve banking system, the Holy Church, the Orthodox Church, doesn't want the people to know what's really going on with the bloggers or shows like this, Keiser Report, Markets, Finance, Scandal, that actually tells the people what's going on. The high priests of the Orthodox economic Mandarin-driven psychosis fear the truth.
Well, this is the world that these experts have delivered us. Some headlines. China's chief auditor warns mounting local government debt a risk to economy. So all the received wisdom, of course, is that China will save the day. Apparently, there's more debt in the provinces of many Chinese provinces, worse than Greece. Greece puts its islands up for sale to save economy.
Who predicted that?
Well, you did, Max.
That's right.
Apparently, in a desperate bid to repay debts, they're selling off parts of their islands, including Mykonos. This is another thing you predicted. California welfare cards can be used in many casino ATMs.
Oh, I love this story. I love it. Tell the people more.
So an LA Times review found that more than half of the state's casinos and gaming rooms, welfare recipients were able to use their, credit card, basically electronic card for transfer of welfare benefits. They could use these at casinos, and they were.
The casino gulag industrial complex is on the rise. Take your welfare swipe card, plug it into a slot machine, and add to the GDP of the country. That's right, we'll make it up on volume. We lose on every transaction, but we're going to make it up on volume. Good thinking, Ben Bernanke.
And then the high priests of the global economy, the G20 met, and the headline from them reads, G20 decides to have deficits, despite Obama's concerns.
Well, Obama is not really concerned. He was given a script to read from, Paul Krugman over there at the New York Times. He himself knows nothing about economics, unfortunately, and he refuses to grab the bull by the horns like Angela Merkel. over there in Germany. She knows what she's doing.
Yeah, but it's also, it's fake war. They're pretending to the population that we're debating these issues. It's the high priests are having a confab and deciding what is best for the world. But in fact, they've all transferred the debts to us from the banks, and this is the result. We're in trouble.
That's right.
Well, that brings me to the next headline. RBS tells clients to prepare for monster money printing by the Federal Reserve.
Monster.
Yes, this is the very same Federal Reserve that just said, you, the people out here, don't know what you're talking about. So Andrew Roberts, credit chief at RBS, Royal Bank of Scotland, I believe, which is now owned by the UK taxpayer, he says, quote, "We cannot stress enough how strongly we believe that a cliff edge may be around the corner for the global banking system, particularly in Europe, and for the global economy. Think the unthinkable. The Fed is soon going to have to pull the lever on monster quantitative easing." And the numbers they're putting out is like $2 trillion.
Whoop-de-doo! There's still $100 trillion in bad debt and derivatives. $2 trillion isn't it? $20 trillion wouldn't be a spit in the ocean as compared to the bad debt still in the system. The trend is deflation, quantitative easing. There's never going to work. The gold vigilantes, as we've been talking about, have sussed this out long ago.
Well, in the article also quotes Societe Generale's Albert Edwards, who said, despite what all these guys are telling you at the G20, that we're going to have these austerity measures and do all this stuff, he says that central banks will be forced to print more money. Whatever they say now, they're going to be printing money, given the stinking fiscal mess across the developed world. He said, quote, "The response to the coming deflationary maelstrom will be additional money printing that will make the recent QE seem insignificant."
Right. Now, George Osborne and David Cameron over in the UK, they made a big thing about, Tories are back in the office. We're going to impose austerity measures. We're going to try to get this country back on a firm foundation. Now, let me tell you something. The social unrest that'll come at the tail end of this particular phase of austerity measures will stop them dead in their tracks. They will resume quantitative easing. And the British pound, like the U.S. dollar and the euro, will all crash relative to gold.
Well, speaking of gold, that's in my next headline.
Talk to me about gold, and I want to do a better cheek pop. That's a proper cheek pop right there. The sound man is saying yes on the cheek pop.
Gold price a bubble waiting to pop. This is Rory Robertson from Macquarie Bank in Australia. He says rather than worrying about U.S. Treasuries or Australian house prices, quote, he doesn't see a bubble in either of those assets for fundamental reasons. Punters should be skeptical of gold around $12.50 an ounce, almost quintuple its early 2001 price of U.S. dollars 260. Let's take a little look at this charts from Steve Keen.
Yeah, the number one economist in the world, Steve Keen. Tell the people.
Inflation-adjusted house prices. If you look at the blue line there, you see Japan, and you see their bubble rise up into the 80s and then crash from 1990, and it's still continuing down. The red line, that's the U.S., and you see the bubble that's popped since 2006. The black line is just unbelievable. Look at that. That's Australia. Those are Australian house prices. And this is the same guy saying that this is not a bubble in Australia. He's saying that gold is. Which, Max, takes me to this chart from Keiser Research. 2010 gold price, what bubble? As you can see, the orange line is the 1970s gold bull that turned into a bubble. The black line is the NASDAQ bull market that turned into a bubble. And the yellow line at the bottom, that's the modern day, the gold bull market. And you can see it's nowhere near bubble proportions compared to other bubbles.
Who wrote this?
This is Macquarie Bank chief economist Rory Robertson. He's the one that won the bet against Steve Keen.
Lucky.
Just on the timing of the housing bubble crash.
Even a blind pig finds an acorn every now and then. Let me explain something to you, Rory. There's a product out there called Thorazine. It's an antipsychotic medication. You need to prescribe yourself massive quantities immediately.
Well, I think the lithium might be cheaper from Afghanistan.
Well, after the U.S. totally blows another trillion in Afghanistan trying to get all their lithium out, the prices should come down, yeah.
Well, then there's another article related to this Australian property bubble, which Macquarie Bank says there is no property bubble in Australia. Housing market a time bomb, says investment legend. This is Jeremy Grantham, and he was in Australia in the past week, and he said the Australian and British housing markets are the last two bubbles left in the wake of the financial crisis, and it is only a matter of time before they crash. Regarding specifically the Australian market, he says you cannot possibly miss it. The price of housing typically trades about 3.5 times a family income, and in bubbles it ends up going to 6 or more. Australia is having one now. You are at near 7.5 times family income, which suggests you are twice the size you should be.
Right. So it took 3 years, going back to 2007, the beginning of the credit crunch, as we now know this period to be. Chuck Prince at Citigroup called it. He said, as long as the music's playing, we're going to keep dancing. He's talking about securitizing, creating that inverted pyramid scheme, the Bernie matification of the U.S. economy and the global economy. And then over the past 3 years, you've seen different parts of the economy crash and deflate. The New Zealand and Australian property markets are kind of the last vestige of the bubble years. Now, once these two crash, then it'll firmly be established a global deflation depression. Paul Krugman is saying in the New York Times this week that we've entered the third major depression, the 1930s, the 1870s, and now the 2010-2011 period, the third major depression, which is a deflationary crash.
But looking at these charts again, it brings you back to the article about economics is hard from the Federal Reserve Bank of Richmond. So they're saying that we understand the magic. You might look at that chart and it looks like simple mathematics that it has to fall. But we have some magic thinking that explains why we can continue living in a fiat fractional reserve currency world.
As the final deflationary nails are hammered into the global economic coffin, the monetarists like Greenspan and Bernanke can get jobs opening for David Copperfield and perform illusions for the audience and say, we can't tell you how the tricks are done because, after all, then you would probably stone us to death as witches, which I'm surprised has taken this long to begin with, considering what they've done to the American and global economy. Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more after this, though. Stay right there.
Hungry for the full story? We've got it firsthand. The biggest issues get a human voice, face to face with the newsmakers on RT.
Welcome back to the Keiser Report. Time to go to New York. Talk to Josh Brown. Josh is a wealth manager who also runs the reformedbroker.com blog, which is about Wall Street, the economy, politics, and anything else. Josh, welcome to the Keiser Report.
Thank you so much for having me. It's a pleasure.
All righty. Now, this is interesting. The Federal Reserve Bank Representative Kartik Arithia has said that don't listen to bloggers. They don't know what they're talking about. Listen to us, the experts. What's your thoughts?
I guess it's funny to have someone from the Fed basically say only economists are qualified to talk about economics. I would argue the reverse. Economists have not really demonstrated that they are qualified to talk about the economy or economics either at this stage in the game. So I think it's kind of ironic.
All right, now, before we go on here, the G20, they just met recently up in Canada. They talk about the economic gangs of New York. Now, in a recent blog you post on your site, it does a great job of laying out the players of the global financial crash battlefield. And we'll get to the inflation-deflation point again in a few minutes. But let's talk about the economic gangs of New York, Josh Brown.
You know, a lot of the readers of my site are not Wall Street insiders or economists, but they are people who have decided that they have no choice but to keep up with what's going on and what the discussion is. The macro has really supplanted anything on a micro level, even for hardened bottom-up stock pickers. So I thought it would be helpful to kind of lay out the 8 most prominent groups and what their economic views and desires are.
All right, so let's frame this for the folks out there watching the show. You're talking about the macro issues versus the micro issues, and kind of the big picture here. In other words, for 25 years, we had a benign environment in the U.S., particularly around the world. We had an environment of falling rates due to when Alan Greenspan came into office. And so investing was kind of a one-way bet. And they even had a thing called the Greenspan put. Every time there was a crash, like the crash of '87, or a long-term capital management crash, or the Asian financial crash, or the Mexican peso crash, all he had to do was just drop rates and increase the money supply, and the bull market was always intact. It was always a bull market. Then in 2007, the game changed. We hit into a new period. And you're saying these gangs of New York. I mean, tell me a little bit more about the gangs of New York as they relate to this transition from the 25-year bull market to now we're 3 years into the deflationary bear market.
So you've got a couple of really prominent groups, and everyone knows what I call the gang leaders, so to speak. You've got the V-shapers who are looking at what I consider to be rebounds off of very low levels in a lot of surveys and reports. And I would say that the V-shapers are being led by a lot of personalities on financial television, as well as some brokerage firm strategists. Then you've got what I'm calling the New Jack Keynesians. These are the people that say everything will be fine, we just have to spend a hell of a lot more than what we've already spent. Which we can get to as a kind of a sidebar. And then the double dippers, who I think are taking the driver's seat here. You're hearing a lot more people come out in the camp that, yes, we had a nice bounce in asset prices, but you ain't seen nothing yet.
Okay, so as a money manager, and as you're pointing out, there's a macro story here is important now for everybody because we're out of this easy money period and we're actually in a period where money matters. So in the case of the Keynesian stimulus, flood with more money, more stimulus, Paul Krugman style, this would actually be a negative for bonds because it's inflationary, whereas the austerity camp, which we've seen in the last year, and we've seen bonds outperform because austerity and is typically the beneficiary would be the bond and the Treasury bond market.
Well, the bonds are indicating that they like austerity-type headlines. I think the real story is two things if we're going to talk about the Keynesian stuff. Krugman's got a piece out this morning calling for the third U.S. depression. And he's making his argument that austerity is a great idea, but it's precisely the wrong time. There may be some merit there historically, but I think we have to draw the distinction. Not all spending, deficit spending is bad. Not all stimulus is bad. And I may be in favor of more spending if we had some results, if we were doing the right type of spending. When you see half the jobs created are coming from government or census workers, that's the wrong kind of spending. So it's not spending that's, in my view, that's de facto evil. I think the type of spending and the results we're getting is really where my quibble and a lot of people that I respect, that's where the real fight is, in my opinion.
Now, I heard in your answer there a slight tinge of politicalization of what's going on here. In other words, you're saying if the...
Heaven forbid.
You're saying that you see, this is the thing. Another interesting trend is that for 25 years, money managers could be apolitical and just go with the market. But now that you've got social unrest, people are saying, wait a minute, these decisions are actually causing potentially huge social unrest like we haven't seen in a long, long time. So let me get back to my question. So in other words, you're mentioning a little bit of a political angle here in terms of the quality of the spending. So am I hearing that you're not happy with the way the money's been spent so far in the U.S.?
I don't see the number one engine for job growth getting any kind of, and let me back up for a second. You gave me a nice little introduction, and more specifically, when I talk about high net worth investors, the vast majority of my clients are small business owners, and I do business with people in 20 or 22 states right now. And when I tell these guys what the markets have been doing, especially during the rally, they are flummoxed. They don't get it. and they are not seeing any kind of effect from stimulus at all. And these are people that run businesses in virtually every sector of the economy. So I don't mean to be political in terms of being on one side or the other, but if they say small businesses provide 40% of hiring, where are the tax cuts for small businesses? Where are the incentives for small businesses to get up off the mat? Because so far we've stimulated asset prices, we've stimulated large banks, we've gotten them up off the mat, but I don't think we've really done much for the average small business owner in this country.
Okay, so in other words, it wasn't a political statement, it was an anecdotal statement. So you're saying that based on your experience with your small business owner clients, they're asking, hey, we injected, by some estimates, $15 trillion into the economy. They don't see it in their businesses, and yet the banks seem to be enjoying record bonuses. Am I correct when I say that back in 2008, Obama had a choice whether to bail out the creditors or bail out the debtors, that is to say the mortgage owners and the credit card owners? Instead, he bailed out the creditors, the banks. Would he have gotten a bigger bang for his buck had he bailed out the debtors and not the creditors?
Possibly. I think maybe it's a little bit more nuanced, and maybe when you lend somebody tens, hundreds of billions of dollars, when I say somebody, I mean an industry, wouldn't it be smart to have some preconditions prior? And we're not, by the way, we're not just talking about checks being written. We're talking about quantitative easing in general. We're talking about monetary policy, punishing seniors who now can't get a rate of return without going out a little bit further on the risk curve. If you're going to do all of these things, and that's the choice that you've made, where were the preconditions about how much can be spent repairing balance sheets versus how much should be spent making loans or doing things that would stimulate the communities that these banks inhabit? So I just think it was like a giveaway. And I guess that's my critique. Bailing out the debtors is an interesting idea as well. But I just think more could have been done, even though that's the route they chose, to bail the banks out directly.
Of course, seniors going further out on the yield curve, there's a place out there on the far end of the yield curve called death. And of course, that's the only place that seniors are going to get any kind of return on these bonds. Anyway, so now the new financial regulation bill in the U.S. just passed committee.
Yeah.
Tell us about it. Is it good?
Right.
Is it bad? Is it ugly? Does it stink? Is it beautiful?
No, it doesn't stink, but it is it's clearly a bigger compromise than probably we should have had happen. And again, this is not to get political, but I think we lost a little bit of steam on financial regulatory reform by not getting it done in 2009. The president had a mandate to come in and put his sheriff's badge on and get things done. They chose to do health care first. Now we've gone X amount of time. A lot of the furor has subsided, and as a result, the bill is a big compromise. It doesn't stink, but I think the most fundamental flaw is that we still have what I call the hexopoly. The big six banks are still too big to fail, and there is nothing changing the fact that they are so ingrained and interconnected that should we be hit with a crisis in a year, 2 years, 3 years, we will still be faced with the fact that someone's got to be bailed out. And that, I think, is the most unfortunate flaw in the bill.
All right, note to the graphics department, put up hexopoly on the screen there, and we'll get the actual six banks for the hexaglopic image. I think you may have coined one there.
I think we all know the names.
But I mean, what about the old tried and true oligopoly as an oligarchy?
Right.
Oligarchy, ring a bell? I mean, feudalism?
Oh, sure.
But,
Sure.
that's anathema to, of course, as your small business owner that you work with would tell you, that he seemingly goes against the whole idea of a free market capitalist society. Anyway, let's move on. The G20 says they're going to cut their budget by 50% over the next few years. Your thoughts?
I don't really know where the budget goes, and I'm not quite sure how it's spent, and I don't know if they were very explicit about where that budget will be, where the cuts will be felt. But I guess I'm as interested to see how that works out as anyone else. I'm not too upset about it.
Unemployment benefits are being cut for 2 million Americans over the next few weeks. Are there any discussions in the U.S. about how to actually build an economy that creates real wealth, creating real jobs, rather than just the Ponzi scheme service jobs on Wall Street?
You know, I think it comes back to stimulating and aiding and abetting the segments of the economy that actually hire. I talk to people that would love to hire. They don't know how healthcare is going to impact them, and they're not getting any kind of assistance versus what large corporations have gotten. So I think until you really look at that and address that, I don't see how we create anything.
Well, talk about healthcare for a second. On the healthcare issue, in the old days, before the healthcare reform bill, the healthcare industry would have to lobby Washington to pass laws to bilk U.S. citizens. Now, with healthcare reform, they can bilk U.S. citizens directly and avoid the middleman.
They claim they want a free market, and they don't. And you know, at the end of the day, they don't want to compete. They do not want insurance companies from other states coming into expensive markets like New York with cheaper plans. They want their little fiefdoms. They want to be unfettered when it's helpful for them to be unfettered. But they do want government assistance in terms of preserving monopolistic scenarios that they've enjoyed almost forever. So I find it very disingenuous when healthcare insurance companies and their lobbyists come out and claim they're looking for free markets. It's absolutely the opposite of what they truly want.
Josh Brown, thanks so much for being on the Keiser Report.
Well, thank you very much for having me. Thank you.
All right, that's going to do it for this edition of the Keiser Report. I want to thank my guests, Stacy Herbert and Josh Brown. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.